right, I'll have you bring your conversations to a close then, please. That's great. So hopefully you all enjoyed the long weekend. You went home maybe for the first time or maybe the second time, and you promised yourself you're going to get caught up, right? You're going to bring home your books. You got 4 days. You're going to get caught up. Yeah, that didn't happen. Same thing when I was an undergraduate. Bring all the books home thinking, wow, all this time, I'll get caught up. I'd leave the books by the door. They'd stay by the door. So when go home, go back to campus on the train, and oh, damn, didn't do anything. Didn't even open it up. Anyway. Well, yeah, you need that time, though. You have to have a break from it once and again, now and again. All right, so yes, I had a great weekend. Lots of turkey, lots of family. It was wonderful. Saw all my sisters, all my nephews and nieces. It was great. And I didn't check email once, so I apologize if you emailed me on the weekend. I didn't get back online until Monday. Anyway. So this is a calendar I posted here on WebCT, just so you know what's coming up. So I've written down all the big things anyway. So yesterday there was your third quiz that was actually due. All right, and another one opens up the same day. And I've already gotten an email about somebody attempting that quiz, and some of you are right there. That's fantastic. Doing the next week's quiz, although I don't cover the actual material until the Thursday. Anyway, so there is one quiz that is open now. It is due next Wednesday. Okay, it's on Chapter 8. We're going to cover that today. All right, but you'll notice that there's this blank spot on the 27th. There will be no other quiz opening up on the 20th. Generally, we, like I say, open up one, close another, and because of the week of the midterm here. All right, so I'm giving you a bit of a break. All right, so those of you who are desperately wishing for a break, there it is. So there'll be no new quiz open, no new quiz due on the 27th, all right, because there is a midterm on Friday, October 29th from 7 to 9 p.m. All right, so this is in your course outline. All right, so just want to bring that to your attention yet again. Then we're back on track for quizzes. There's another quiz due on Chapter 10 here, November the 3rd. All right. So I've posted a few announcements in relation to the midterms. So where are we here? So yeah, so TA office hours. You do have two TAs, right? But all that they'll be doing for you is they monitor the discussion board, answer questions on your chapter-specific questions. They'll hold office hours before your midterm, okay, and before the final exam. Right? They are accounting students, third and fourth year accounting students, right, who really know their stuff. Right? So take advantage of these office hours. Okay, so that's in 830. DT stands for Dunton Tower. All right, so 8th floor. Yeah?
Can we go over the CNOW quizzes in office hours?
With them, they don't have access to them, but certainly come see me, before class, after class, during my office hours. Yeah, certainly. So they're holding office hours the 2 weeks leading up to the final exam. And look at that, Kathy's even holding office hours the day of the midterm, right? The day of your midterm exam. So she's going to be inundated. I told her that. Expect lots of students then. Okay, and because of the midterm, I'll be holding extra office hours. Okay, I'm just extending my usual office hours. So next Thursday, the following Thursday from 12 until 2. All right, so just those 2 days. And my office, I need to repeat it, 2014 Dunton Tower. That's the 20th floor, right? Get some people going to the second floor wondering, where are you? It's the 20th. And because of the midterm, what I like to do with all my classes is just post some suggested problems. Okay, it's kind of like a homework list, right? So I've done that. And if you go under course slides, open the file under midterm exam, you're going to see just some problems I'm suggesting that you do to prepare for your midterm exam, right? So try those out. So I'm wondering, where is that document? So if you go here to the home page, to the PowerPoint slides, let's just cancel that. It's at the bottom. So I posted a midterm review down here. Let's open that up. I think it might appear in the same window, I'm not sure. Oh, no, new window. Okay, so there you go. So by chapter, what I'm suggesting that you try out. You don't have to do them all, okay? If you're finding chapter 1 was really easy, don't do all of them. Do 1 or 2 of these, okay? So for most chapters, I'm suggesting you do that illustrative problem. Okay, it covers a lot of the learning objectives. You get a lot of concepts thrown at you, so that's good. And then, I always recommend redo your past problems, okay? You've been going to past. redo those. And the problems that I've taken up in class. Right? So I do post those solutions, right? So all the paper that I go through here at the end of the day, I'll scan and post those. So you do have those solutions. And then some extra problems from the textbook, right? So problem 1-1 on page 27. And what I've done here is just put the solutions here at the bottom of the document. Okay, so you've got just solutions to selected problems. Okay. And then as we started to do See Now quizzes, I'm also suggesting that you try out the See Now quiz. Okay. Redo those. Okay, you do have access to them, right? You can go in, check them out. And what I mean by do them, I don't mean just read these things over. Okay, it's wonderful just to read through an illustrative problem or read through the solution to P1-1. I mean, take out a blank piece of paper, take out your calculator, take out a pen or a pencil, and do them. Okay, and not with the solution in front of you either. Okay, just reading the solution is of little or no help. Okay, it will not get you far. Okay? So in order to truly understand the concepts, you have to actually do them. So, illustrative problem on that first chapter might be, prepare a balance sheet. Okay, well, write down all the accounts. Right? Identify what's an asset, what's a liability, what's a shareholder's equity account. So that's just what I think would be a good review. Steve Byrne here? No, not yet. PASS will be also having a mock midterm. I suggest you do that as well. Okay, so he'll be making announcements probably in WebCT and in class about that. So what he does is he takes some really good problems he puts together, and he'll post that on WebCT in the discussion board for PASS, and then attempt this mock midterm, and then go to one of the sessions. He'll take it up together. Okay, some really good ways of connecting with other students, working through problems. That's PASS. What else did I want to... announcements, TA office hours, my office hours. Oh yeah, and the midterm exam itself, I don't have the rooms yet. Did I mention that? Midterms, no I didn't. But as soon as I get the room numbers for it, it is Friday, October the 29th, 7 to 9 p.m. Right? So all the room assignments have yet to be made by CUTV Examination Services. As soon as they've done that, I'll let you know. Okay, I'll let you know in class, post an announcement on WebCT, and I'll probably put it on the main page too. Okay. Any questions about midterm exam? No? All right. Good. So, what else did I want to do? I think what I'll do is I'll go through the See Now quiz afterward. Just so, because if I show it to you now, material is kind of like, what? What is this? Yeah, so I'll do it afterward. So I've got one on shareholders' equity here. And there's 3 problems this time. Bonds. So maybe after I take up bonds, I'll do that one, look at that one. And product warranty. Okay, so that one I'll have to certainly do first, because that comes up first. All right. So we're on Chapter 8. And we're really delving in more specifically into parts of the balance sheet lately. Okay, so we have an appreciation about liabilities and shareholders' equity, but we certainly don't know all the details of what amounts we're going to capture, how do transactions affect liabilities and shareholders' equity, but we will today. All right. Now, what happened to my screen here? There, okay. I'll go through them. There. All right, so the learning objectives, I am covering most of them here from the chapter, but I do have to caution you about this chapter. This is an American textbook, so it's got a lot of American concepts and things that we don't necessarily have here in Canada. All right, so when I cover them, you're going to notice that my PowerPoint slides are pretty significantly different from the chapter. Okay, so I will talk about how businesses finance their operations. That's pretty generic. But when I talk about current liabilities, especially payroll, right, I'm going to be talking about Canadian payroll, not American payroll. Right? So, and when I talk about bonds, that's pretty much the same as in Canada. But when I talk about learning objective number 4, issuing stock, that is really different in the States, okay, because of a concept called par value, which we've pretty much done away with since the early 80s. So you're going to have to pay close attention to my slides. Right? I'm just warning you. Accounting for cash and stock dividends, that's yeah, it's about the same. Stock split's about the same. But certainly the financial statements reporting of stockholders' equity. You know, they like to use the term stockholders' equity. Our statement looks a little bit different. We don't have certain accounts that they have. So pay, again, close attention to my slides because I'm not covering it the way the textbook does. All right. Oh, yes. And the other thing I think I've pulled out of here is just treasury stock. I'm not going to cover that whatsoever, right, because it, by and large, does not exist here in Canada. Right? So the textbook talks a lot about treasury stock, and I'm not. All right. Okay. So businesses who are growing, right, especially those that are growing, need to finance their expansion through one of two ways, and that's go find a loan somewhere, debt financing. All right. So loans, issuing bonds. Okay, that's another way that companies can get some capital. Right? And another way of getting some financing is through issuing shares. Okay, finding some more owners in the company. Right? And I was reading the paper. This was a while ago, but I thought it was pretty pertinent to what we'll be talking about today. So this is the Ottawa Citizen from September 30th. So no, that's been a long time ago. It's about 2 weeks ago. There was an interesting article about the Ryder Cup. I don't know if you can see here our Canada billionaire, Sir Terence Matthews, here in the background. He won the rights to host the Ryder Cup. Okay, so that's Ryder Cup was in Wales, right, 2 weeks ago. So you got a picture here of Sir Terence Matthews, Prince Charles, and John Germain, who's chairman of the Ryder Cup Wales. They met at Matthews Celtic Manor Resort in Newport, Wales. So Sir Terence Matthews is from Wales. He lives in Canada. He's a high-tech entrepreneur, done really, really well in the high-tech scene here in Ottawa. But he's talking about just the background of Sir Terence Matthews, which I thought was rather interesting. His father was a miner, and his father would have been proud beyond belief to see his only son dine with royalty. He would have been even more surprised at Terry's relentless pursuit of the right to provide a playing field for golf's top stars. It was a big golf tournament, right, in Wales. On the second page this is rather interesting. It talks just a bit about Matthews' investments. Okay, so I'm looking at here. So he built, Matthews has invested more than $250 million since 1980 on the golf course. He acquired hundreds of acres on the outskirts of Newport, property that includes the nursing home where he was born and the site of a permanent Roman base. Matthews built a 330-room, 5-star hotel, so he's expanding, right? How do you do this? And this hotel is for the week was a home to the Ryder Cup contenders. Matthews' investments in South Wales were noticed. He received a knighthood in 2001. Coincidentally, the same year he won the right to host the Ryder Cup. Despite these personal victories, it proved a stressful time. In 2001, his principal asset, he had a minority stake in Alcatel, which is a Paris-based firm that acquired Newbridge Networks in 2000. The share value plummeted. He lost billions virtually overnight. All right? So this is what happens when you become a shareholder. You have highs and lows with your share price. He's still wealthy, but the demands on his remaining assets were many and large. He had reacquired Mitel Networks for $350 million, spent $115 million to open the Brook Street Hotel. So those of you in Canada, you know what I'm talking about. Brook Street Hotel, and the adjoining Marshes Golf Course, not to mention investing tens of millions in a variety of startups. He's a real entrepreneur. He sees ideas and he wants to support them. His friend and colleague Simon Gibson later acknowledged that in 2002 he and Matthews did well to keep things afloat at Wesley Clover. That's the holding company for Matthews' many business interests. Eventually Matthews sold enough Alcatel shares to help absorb the losses and made fresh investments. Debt financing and government loans did the rest. Through it all, he kept his eye on the Ryder Cup. So this is how he's done his expansion. Okay? So this slide speaks to debt financing versus equity financing. He sold shares and acquired some debt financing and government loans. Right? So that's generally how we expand. And he did a lot of expansion there. Right? He constructed Brook Street. He did a lot of construction in Wales for the Ryder Cup. So this is how businesses do it. Right? If you find a business that needs to acquire debt financing or equity financing just to stay afloat, you're probably in a very risky business. All right. So in a business, we hope that our general coming in from sales and whatnot can pay our suppliers and pay our employees. And if you can't pay your suppliers and your employees with the sales, the cash from the sales that you're making, then you are probably in a very risky business there. If you need to secure a loan in order to pay those things, something's going wrong, right? You might want to take a look at that. So generally, we look at debt or equity financing to expand. So let's take a closer look then at current liabilities. We're going to take a look at both sections here, the balance sheet liabilities and equity. Current liabilities, those things, obligations due within a year, okay, of the balance sheet date. Right? So that's why we see the word current there. Okay? Same thing as in current assets, when we see that word. What's going to be used up within a year. All right? Current liabilities, what has to be paid within a year. All right? And so yeah, or the company's normal operating cycle, whichever is longer. And we measure these at cash equivalents, okay, so no surprise there. Okay, so what are some examples of some current liabilities? First and foremost, accounts payable. So you go to your supplier, you buy a good or a service, and you say, hey, I don't want to pay you just yet, so you send me an invoice. And a lot of suppliers are more than willing to send you that invoice, and you'll pay later, right? And generally, we give people 30 days to pay in that sort of business transaction, right? So after 30 days, most likely they're going to start charging you interest, start phoning you, harassing you. Yes? Oh, yeah. So, sorry. Well, if it's over a year, no, they're going to be a long-term liability. Okay, so the question was, what about those things you hear on TV? You buy this, this big screen TV, don't pay until 2012 or whatnot. So if your supplier is going to give you terms like that, that's a long-term liability if it's more than a year. Right? So it'll go in another section of the balance sheet. So accounts payable is generally used just to buy your goods and services in the normal operation of your business. Your suppliers say, I'll send you an invoice. They send you an invoice. You've got 30 days to pay. And, a lot of people use this to, in an inexpensive way, as I mentioned here, to finance the activities of a business. Right? I was watching this really interesting documentary on TV about Ted Rogers. Okay? So Ted Rogers, from Toronto, founder of, I think his father started Rogers Radios, but anyway, and that became Rogers Communications. So those of you who maybe have a cell phone plan through Rogers, or go to the Rogers DVD store, or subscribe to Rogers Cable, Rogers Phone, this is all from this company, Rogers Communications. So Ted Rogers recently passed away, and so they've been doing a little bit of documentary. You see his name pop up. Some books have been written about him or whatnot. So I was watching this interesting documentary on the weekend about Ted Rogers and his management of accounts payable. Right? So he was reflecting back on the days of expansion. So he's in the 60s. He had acquired a radio station in Toronto, and he started to get into cable. And so he's expanding, and cash is really tight whenever you're expanding like that. Right? So he's having a hard time paying the bills. So what he would do, he'd take all the invoices from all of his suppliers at the end of a week, put them into a hat. Okay? Because cash was really, really tight, all right? And so he'd, decide, okay, I've only got so much money this week. I made so many sales and collected so much cash. I can only pay so much. I'm going to pull invoices out of the hat until I've, paid invoices to the amount of the cash that I have. That's how he managed accounts payable. And he said, a lot of his suppliers didn't like that. They would phone him and yell at him, actually, and say, pay my invoice. You're over 30 days. And this is generally what happens whenever you don't pay your suppliers within 30 days. And he said he couldn't understand that. Here is this innovative way of managing accounts payable by just pulling invoices out of a hat until he had used all of his available cash. And so he told them, you know what? Don't stop yelling at me, or I'm not going to put your invoice in the hat. Okay? It won't be considered whatsoever for payment, okay? But he said, at the end of the day, this is very interesting. He paid all of his suppliers. He never got insolvent. Everybody was paid exactly what they were owed. Just took a little bit longer than the 30 days, right? So this is why I think that little blurb there at the bottom. Yeah, it is an inexpensive way to finance your activities because there is no interest, right? For 30 days, anyway. Another current liability is notes payable. Okay? So you sign a promissory note, an IOU. Okay? And you could use it to settle an account receivable. Okay? So business lends money to or when a business lends money to an individual or another business. So they're sometimes called IOUs. Right? So if you were the borrower, you're going to have a note payable. Okay? And it generally comes with interest. Right? So we take a look at what a promissory note looks like. And if a business signs one, it'll just say, I promise to pay. That's where you see the word promissory note. So let's say I owe, I don't know, Payne Enterprises. Enterprises, $100. And you have to specify the date when you're going to repay them. Okay, so I'll pay them on Christmas. Okay. And you usually have to specify a rate of interest. Okay. And then only the borrower actually signs this and dates it. It is today, it's April 14th. All right. So that's a promissory note. Okay, so not even the lender has to sign it. It's just the borrower that has to sign it. Okay. So we've got what's called the principal, how much money I now owe Payne Enterprises, $100. Comes with interest. And this interest rate is always an annual interest rate. You rarely ever see interest stated in anything but an annual interest rate. So if I don't pay this loan, this principal, over a year, I'll owe an entire 4% interest, so 4% of that, $4. But if it's just for a partial year, I'm going to owe part of the $4. Okay? So how do I calculate that interest? I've got the formula here. This is the formula for simple interest. All right? So, and that's all you need to know so far in this course is we're going to take the principal and multiply it by the annual interest rate. Okay? So as I mentioned, interest rate's almost always stated on an annual basis. And sometimes you might see something like this, a little PA beside it. That just means per annum. Okay? It's just generally, though, thought to be, we assume any interest rate is an annual interest rate. If I multiply the principal by the annual interest rate, okay, as I see now on the slide, I will get the whole interest for the entire year. Okay? But if I want to look at just a partial year, I'm going to multiply it by the portion of the year that I want to accrue for. Okay? And generally, we do that something over 12 months. Okay? So, if it's for 2 months, and I'll just multiply that whole amount there times 2 over 12. Okay? If it's for 1 month, times 1 over 12. I could also be really specific, okay, and do it over days. Right? So I've got annual interest so far, and I want to know, okay, how much interest will I owe Payne Enterprises, and I want to calculate it on days. I can do that. I'll just multiply by the number of days over 365. Okay. All right. So here's an example. Business signs a promissory note to settle an account payable. Okay, they say, I can't pay you just yet. Give me a little bit longer. And they say, fine, but I want interest. Okay. So November the 1st, Newman Enterprises signs a $10,000 promissory note. Interest is at 6%. They pay back the $10,000 in 6 months' time. Okay, so that time they're going to pay back $10,000 plus some extra. So when the note is signed, this is the entry we're going to make. Right? So accounts payable is actually going down. We're settling the accounts payable by signing a promissory note, so that end is going to go up. Okay, notes payable is going to go up. However, so many months later, April 30th, 2011, the note is repaid along with accrued interest. Okay? Accrues just means I'm going to account for it, okay, for the 6 months. And so I use my formula for simple interest. Okay, and this is one of the formula that you will have to memorize for the midterm. I'm not going to give that one to you. So we take our principal times the annual interest rate times the time period that I'd like to accrue for. Generally, for this sort of course, we do this over 12 months. Okay. So Victor Newman borrowed $10,000. Interest almost always stated on an annual basis, so times 6% interest. If I just multiply those two things together, I'm going to get interest for the entire year. However, the note is not outstanding for the entire year, so I multiply by the portion of the year that it is outstanding for. So 6 times 12 here. Okay. And when I do that, I get $300. So here's the entry that we're going to record 6 months later. Okay, we're going to pay off the loan, the promissory note, the principal with interest, which means it's not just $10,000, it's $10,300. Right? From the $300 here, we've got an interest. The note payable is going to go down by $10,000, and we've incurred some interest expense. Okay? So that's going to bring down retained earnings. Okay? And there we've paid off the invoice, okay, the promissory note. All right. Another current liability, income taxes payable. Okay. So what companies do, at the end of a quarter, in this class we often say, at the end of the year, okay, or you could also do it at the end of a month, is we accrue the income tax that we owe to provincial and federal authorities. Okay, so in Ontario, if you were a company that's set up business here, you don't just have to fill in a federal income tax return, you have to fill in something called a C2, an Ontario income tax return. Right? So we think it's onerous just personally to fill in one income tax return. If you're a business, it's two. Okay? It's provincial and federal. Right? Anybody from Quebec? You do already, right? You do your federal and provincial income tax return on the personal side. Okay? So that's how corporations must do it as well. So what we do at the end of the month, the quarter, or the year, okay, is take a look at how much was our income before income tax. Let's calculate that. And it's accounting income before income tax that we're going to use. Okay? So if a company's made, let's say, $1,000 net income before income tax, okay, so before they get to that, they're almost at the bottom line of the income statement, but not quite. They're one up. They take a look at that number and they multiply by their tax rate. Usually companies know that sort of thing. They know what tax bracket they're in, right? So if it's 10%, that's their tax rate. That's what they're going to multiply the $1,000 by. Oops, that's wrong. I guess there should be another zero in there. Let's make it 10,000. Now the slide works. Right? Okay, so 10% of $10,000 income before income tax. Yes, that is 1,000. It's funny, eh? You drop a zero, it changes everything. Okay. So what they're going to do is set up. Okay. The setting up the liability is step one, right? So income tax payable is going up by $1,000. Retained earnings is going down. Right? That's income tax expense. And then whenever they pay it, they'll make this second entry. Okay. Income tax installments, it depends how much money you owe the government. It could be monthly, it could be quarterly, or it could even be at the end of the year, okay, which is rather rare. Right? So depending on how much you owe, there's certain rules about when you'll actually remit that tax to your provincial and federal governments. But whenever it is paid, you'll reduce your income tax payable and reduce cash. Okay? Bring them both down. Okay. It's just a fact of life, in Canada, income tax. Right? And our income tax rates, yes, are higher than our American neighbors to the south. And there are some countries even where there is no income tax. Do you know what countries don't pay income tax? Obviously, you're not from these countries. Okay. Bermuda, the country without income tax. Can you imagine? You make your paycheck and you actually get most of it. Right? And I think there's a few Middle Eastern countries, too, that don't have income tax system. This is only a temporary measure, after all. Came out in 1917, just temporary, in Canada anyway. I think it's a little bit more than temporary right now. Right. Okay, another liability you might see here on the balance sheet is something called a contingent liability. Okay. So, what does that mean? It's a potential liability that arises because of events or transactions that have already occurred. Okay. So, let's take a look at this chart. What are we talking about? So across the top on this table, we're going to evaluate the probability of future sacrifice. Okay. So just how sure are we that we're going to have to actually pay something in the future? Okay, is it likely? Okay, so we have to assess that, and we're not using like hard and fast rules here. It's up to somebody to have some judgment, some professional judgment, and say, yeah, that is likely that we'll have to pay something. or is it reasonably possible? Or is it unlikely? Okay, so it's a continuum. Is the probability of future sacrifice likely? That's a one end of the table. Or unlikely, and reasonably possible is in the middle. Okay. And why would we even be looking at this? This is the sort of thing we're going to evaluate when we look at warranties, okay, or lawsuits. We've been sued. Okay, what is the likely probability of future sacrifice? Is it likely? Do you think we'll likely have to pay a settlement out of that lawsuit? Is it reasonably possible, or is it unlikely? Okay. And then on this side here, we're looking at whether or not the amount can be or cannot be estimated. Right? So do we know the amount? So you've been sued. A company's been sued, which, by the way, happens a lot. This is the reason why lawyers work for companies, a lot of companies. They have their own in-house counsel. Right? So you've been sued, and so you have to estimate the amount, if you can, and determine, is it likely you're going to have to pay something, reasonably possible, or unlikely? Okay? And then we've got the action. Okay? So if the probability of future sacrifice is likely, and we can estimate the amount, we will record a liability. This will go right onto the balance sheet as a liability. Okay? And this is what happens with warranties. Okay? So Ford sells a whole lot of Ford Fusions, and they know that this car's been out for a number of years, and that they offer warranty on it. And they have noticed in their experience, people do come back and ask for service on the warranty. They say, hey, something's happened with my catalytic converter, or the engine is seized, or something, and they ask for service on that. Okay? And so probability of future sacrifice, when Ford sells the Ford Fusion this year, they'll say, yes, it is fairly likely we will have to pay something for a good percentage of these cars. And can the amount be estimated? Again, in their experience, they'll say, yes, we can estimate the amount. Okay? Based on last year's sales and the year before, about 2% of all the sales we had to pay out as a warranty. Okay? Honor the warranty. So that's where we get warranty expenses from, this contingent liability concept. If it was only reasonably possible that you'd have to pay something, here we're just going to show it in a note to the financial statement. Okay. We're just going to say, yeah, we've been sued, and although, we know the amount, we're not entirely sure of the probability of future sacrifice. It's reasonably possible. Okay. So you often see a note, it's rather generic in a lot of companies' financial statements, that just acknowledges that, yes, we are being sued for whatever reason, and that it's very difficult to ascertain whether or not they're going to have a future sacrifice. All right. Now, if you've got a frivolous lawsuit where the probability of future sacrifice is unlikely, no action in either case. Okay, even if you could estimate the amount or not. Okay, if you're saying, no, they're just wasting everybody's time with this, we're not going to do anything. All right, so then down at the bottom here of the table, if the amount cannot be estimated, we'll notice that we're always disclosing these things in the notes. Okay, so again, you might see another note, yes, we're being sued. Although the probability of future sacrifice is likely, we can't estimate the amount, therefore nothing has been recorded on the balance sheet. Right. So that brings up product warranty payable. Okay. So I bought a new car this year. I haven't bought a new car in a long time. Right? So my old car, which I will not tell you what kind it was 9 years old. It had had enough. All right, I'd replaced the catalytic converter more times than you can imagine, and I was going to the garage every week. All right, I was on a first-name basis with my mechanic, which is not a good thing to be doing anyway. So I bought a new car, and it's got a full warranty, and I'm really pleased about that. All right, so many thousand kilometers or years, whichever comes first, they've warrantied a whole lot of things, except for tires. Of course, all the things that are going to go wrong. Okay. So because it is likely that, I bought a Ford, by the way, Ford will have to honor this warranty and that the amount can be estimated, manufacturers need to record this liability on their balance sheet. Okay, so how are they going to do that? So let's say Ford sells 20,000 Ford Fusions this year at $21,000 a piece. They estimate that repairs expense will total 1% of the sales price. Okay, so that's based on their experience. They've had this model out for a number of years, and they know that a certain percentage of people come in asking for a service to be done on warranty, and that this generally totals about 1% of the sales price. Okay, so it meets those two criteria. It's likely that there'll be a future sacrifice, and they can estimate the amount. Okay, so they should record a warranty expense for their 2010 sales, okay, of $4.2 million. Right? So what entry are they going to record here? Are they going to reflect this? They're going to increase an account. It's a liability account called product warranty payable. So it sits there, it's going to be used up, and they're going to incur an expense, warranty expense, which has the effect of decreasing retained earnings. Okay? And it's really important to do it in the year of sale, okay? And that's all because of the matching principle. Okay, here we go again, that matching principle is coming up. Matching principle says we want to match the expenses with the sales. Okay? So if you make a sale, any expenses that you've had that gave rise to that sale, you've got to record in the same time period. Right? So this is why it's so important in 2010 for Ford to make this warranty payable entry, okay, and record warranty expense. Okay. So then as repairs are made, Ford can then reduce their warranty payable account. Okay. So hopefully there's not too much repairs being made, not too many repairs being made in 2010. But we know that in 2011, 2012, 2013, you know, because this is for a number of years, they'll just draw down on their product warranty payable account. Okay. So, and that can be, you know, the other side of the entry here can be made for anything. If they have to make an outlay of cash for whatever reason, they have to pay somebody's wages. Okay. They have mechanics, right, at a lot of Ford dealerships across Canada, and they pay wages. So then they'll draw down on cash and product warranty payable. Or they might be taking parts out of inventory. Okay, they need another catalytic converter. That's my thing. I always have trouble with catalytic converters. I don't know why. So as those catalytic converters are coming out of inventory, they'll reduce their inventory account and the warranty payable account. Okay. So this is very similar to your See Now quiz. Okay. You are going to be quizzed on something like this, except you have to maintain the balance. Okay. So that's where I think I already received one email about this. You're given the balance at the end of like 2008 and 2009, okay, and you have to know, well, what's going on with this warranty payable account? Okay. So whatever it is, let's go find out. Oh, that's not it. There you go. So yeah, we're given the warranty account. Oh, it's at 2007 and 2008. Anyway. So we see that it's increasing. Oh, this is in millions. Wow. So it went from $4,862,000,000. Oh, it went down. $3,840,000,000. So this is that warranty payable account. Okay, so you need to know, why would this account ever be increased? Okay, and we know that it's increased every year for the estimate, okay, of the warranty expense. And we deduct from this account every time somebody makes a claim on the warranty. Okay. Okay, so as the warranty is being honored. Okay, so in order to get from $4,862,000,000, we know that they would have made an estimate of the warranty, okay, for 2008, and they would have used up this account a little bit as it's being honored. So there would be a plus and a minus before we get to the $3,840,000,000, 40 million. It's all millions. Okay. And so they're telling you what's going on here in the account. So we know the 2008 balance, the 2007 balance. These are all year-end balances. But in order to get from one balance to the other, we know that we've added to it when we record the warranty expense, that estimate, and we subtract from it whenever the warranty is being honored. Okay, so I think that's where this one person anyway was finding it difficult. Okay, and they tell you a little bit about that. They say Ford sales were so much, decreased to so many million in 2008. Assume that total paid on warranty claims during 2008 was $3 million. So they're telling you one of the amounts here in the activity. Illustrate the effects on the accounts and financial statements for the product warranty expense. Okay, so it sounds like that's the plus. Right? So it's working backwards a bit. Okay, that's what you're going to have to do here. And then there's just something talk about why did it go down. Okay, so we know how that account works, and you certainly need to know that for the See Now quiz. Okay, so we'll also do an exercise from the textbook, exercise 8-5. Awesome Audio Works Inc. warrants its products for 1 year. The estimated product warranty is 2% of sales. That's often how it's done. Assume that sales were $500,000 for January. In February, a customer received warranty repairs requiring $2,500 worth of parts. So now let's determine the warranty liability at January 31st. And what accounts are decreased for the warranty work? All right. So I think we know the beginning balance, eh? Do we know? Oh, there is no. The first month of the current year. They're not giving us the beginning balance. All right, so we'll just look at January sales then. Okay, so I guess what they're asking us is calculate the warranty liability that they've incurred for the month of January. And it's, like I say, usually expressed as a percentage of sales. Okay, so if we look at what are the January sales, 500,000. Just multiply by 2%. I can't do that in my head. I don't know why. $10,000. Okay. So that will be the warranty expense for January. Okay. So that's the end of the first month of the current year. In February, a customer received warranty repairs requiring $2,500 of parts. What is B asking us? What accounts are decreased for the warranty work provided in February? What do you think? There's two of them. What's one of them? Be decreased. Hmm? Is it cash? Parts inventory. They use the parts. So if they didn't have it already on file, in stock, it would be cash. Okay. So I'm going to just stick with parts inventory. I'm going to assume that they had, something there. So that'll go down by $2,500. And then the warranty liability here, the warranty payable, will also go down by $2,500. So those are the accounts that are decreased for the warranty work. Okay. Any questions on that? Yes. It would be affected by warranty expense. Yeah, and we'd record that like as an operating expense. So in our multi-step income statement, it's certainly just part of the regular cost of doing business. We'd say, yeah, that's a warranty expense as an operating expense. Right. So whenever we set up the warranty expense, which they didn't specifically ask us to do, but I'm running out of space. But let's say we take a look at how would that be set up in the first place. The warranty expense doesn't affect assets, but it does affect the account called warranty payable. Okay, so they're going to increase that by, $10,000. And under retained earnings, and I do like to do R/E, that'll go down by $10,000. The effect on the income statement is that warranty expense is being recorded here for $10,000. Right. And that's the sort of thing, right, you need to do for See Now, is not just the effect on the accounting equation, but the effect on the income statement.
So when we get paid, do we
When we honor the warranty? Yeah, let me go back to that. We looked at that here in B. It hasn't affected retained earnings. Okay, so there is no effect on the income statement. So that's something to put down. That is one of the options in C now, is you go in an income statement, you say no effect. Okay, and there'd be no effect on the cash flow statement either because we haven't affected cash. Right? We've looked at parts inventory. If we didn't have the parts inventory, that was brought up earlier, and we had to pay cash for the parts, then yes, that's an operating activity on the cash flow statement. Okay. All right, any other questions? What's your questions? All right, let's keep going. Another current liability, payroll. All right, and this is where I will not be covering it the way the textbook does because they're talking about American payroll, and I know nothing about American payroll. I know about Canadian payroll, so let me tell you about Canadian payroll. So as an employer, your employees earn money, $25,000, let's say, for Chancellor Industries. Okay. And if you've ever had any job at any time, you know that you don't make the gross amount of your earnings, right? All sorts of people have hands in your pockets, especially the government. CPP and EI premiums, okay, which are great programs. So CPP is the Canada Pension Plan. When you get to the age of 60, you can start taking money out of that system. More if you wait till the age of 65. If you ever become unemployed, okay, you might want to claim employment insurance or EI. Right? So those are generally a percentage of your gross earnings, okay? And if you don't make enough money, you're not going to get anything deducted, and there's maximums too. So after a certain point, you max out on your CPP and your EI. Income tax, again, you're allowed to make so much money in Canada tax-free. So if you're just making a little bit of money, you're not going to see any income tax. Once you get above the basic minimum, which one is it this year? Is it 10 or 11,000? I should know this, but I don't, because I don't actually ever calculate it. A computer does. So you're allowed to make, let's say, $10,000 or $11,000 in Canada before you have to actually start paying income tax. And then there are graduated rates, right? It's going to be a percentage of your earnings. The more money you make, greater the percentage, right? So it can go up really high, right? So a lot of deductions there on the Chancellor Industries payroll. And as well, Chancellor is also going to be deducting premiums for their benefit plans. Now that could be a pension plan, okay? Like some sort of contribution that employees make toward their own pension plan, or maybe a long-term disability plan, or maybe a health and dental plan, or whatnot. Sometimes we ask employees to actually pay into these plans. Okay? And you might have other ones too. This is not a comprehensive list. Has anybody ever paid other deductions I don't have here on my list? Could be more than this. I've only ever seen CPP, EI, and income tax, and maybe a benefit or two. Yeah?
Like for some of the company, like a share accumulation plan?
Yeah.
Exactly.
Share purchase? Definitely, yeah. You know, attracting good employees and giving them some benefits. Certainly, yeah. Union dues, yeah, exactly. And that's, you know, especially in the public service, you're going to find a lot of unions there, so you have to pay dues into that. Anybody else? No? Donations. You know, the United Way campaign is underway now, and so there's all sorts of workplace campaigns, and they'll say, take some money off your pay, you'll never notice it, right? Take $5, $10, whatever. Okay. What else can we have there? Parking. If you work at Carleton and you want a parking space, you can ask to have it taken off of your pay. Right. And sometimes, you don't see this as often anymore, but Canada Savings Bonds, you know, forced savings. You might just ask your employer to take off more money to put into an RSP. I've done that. Just because you never notice it, right? It comes off your pay. Painless. Anyway, so what's Chancellor going to have to do at the end of the day is record their payroll. And we'll notice here that the total deductions that we have, 2 and 1.5 and 8 and 1.5, that's $13,000. Wow. So gross earnings for the payroll was $25,000. They take off $13,000. That means employees are only going to get $12,000 at the end of the day. Sad but true. Okay, so we know that's one easy thing to figure out. Cash, therefore, is going to go down on the records here of Chancellor Industries. Okay. they're still going to record the gross amount of the payroll here as wages and salaries expense. Okay? That's still a cost that they're incurring. They're just not giving it all to the employees, okay? Because they've had to deduct CPP, EI, and income tax, and some benefit premiums. Right? And when they do that, when they deduct it from their employees' pay stubs and their paychecks, they put it into payable accounts. Okay? So CPP payable, it's going to go up by $2,000. EI payable, go up by $1,500. Okay? This isn't just extra money that Chancellor gets to like sock away for a day when cash isn't so good. They set up a payable account because they owe the money to the government. Okay? Income tax payable is going to go up by $8,000. They owe the money to the government now. Okay? Benefits payable, going to go up by $1,500. Now they owe the benefit plan company. Okay? So a Great West Life or a Standard Life or a Sun Life or whoever's administering this benefit plan. Okay? They're going to record that as a payable. This is not Chancellor Industries money. It belongs to somebody else. Okay? So this is how they would initially record payroll. Employees only get $12,000. Now, that's not it for payroll. Okay? So in Canada, we've got the great pension plan and an employment insurance scheme. Employees pay into it, and you've seen those deductions, I'm sure, off of your paychecks. Okay? Employers also have to pay into those plans. Okay? And what payroll legislation says is that they have to match employees' CPP premiums. So if you put $1 in and you think you're hard-pressed to put $1 in, so does your employer. Okay? So it's not, employers say, oh, I'm giving them $10 an hour. It's not just that. There's this additional cost to their payroll, additional payroll tax. CPP, they have to match it. EI, they don't just have to match it, they have to pay 1.4 times it. Okay? So you put in $10, your employer is going to put in 14. Okay? It's got to be 140% or 1.4 times. Okay? So there's also that entry that's got to be recorded. Okay? So at this point in the game, Chancellor Industries has paid their employees. They have an additional entry to make. One, to match the CPP. Okay, so they're going to increase the CPP payable. And one, to pay 1.4 times the employee's portion. There we go, $2,100. The EI payable account is going to go up. And they're going to record this as an expense. Okay, payroll taxes expense. I've got two separate accounts, one for CPP expense, one for EI in one company. The other company, I just have payroll taxes. All right. And that'll have the effect of reducing retained earnings by $4,100. Okay. Employers don't have to match or do anything with the income tax. Okay. They pay their own income tax, remember that. Okay. All right, so we've got amounts sitting in the payable accounts. Okay. Oh, and I don't have that part of the slide then. And so they will have to remit it. Okay, so CPP payable is going up. We had the employees portion. We had the employer's portion. There's $4,000 sitting there that they owe the government. EI payable. We've got the employees portion, the employer's portion, $3,600. Income tax payable. What was that? Let's finish that. $8,000. Oh. Okay. Depending on the size of the company's payroll, they do have to pay this to the federal government. It could be twice a month, that's more common, or once a month if they're a smaller employer. Okay, so as they pay the federal government on whatever schedule, this will go down. Okay. So they do have to remit that. Okay, and cash is the other side of the entry. It's not as simple as just saying, oh, I'm going to pay the employees $10 an hour. There's an extra cost here for the employer. All right. Any questions on payroll? All right. Next up, we're going to go into long-term liabilities, and we're going to look at bonds. Okay. So this is a way of getting some cash, especially if you're expanding. You're going to buy a building, some land. All right. You want to add to your factory. Whatever you'd like to do. Companies can issue bonds. Okay? So you might only be familiar with Canada Savings Bonds or Ontario Savings Bonds, where a federal or provincial government issues a bond. But companies do this too. Okay? So and it looks like a share certificate. It just says, you know, let's say Newman Enterprises has a bond. And they want to issue $10 million worth of bonds. They want $10 million essentially. That's their intent from interested investors. Investors are looking at Newman. Yeah, he's pretty good. He'll repay us. And wow, that's a good interest rate or whatnot. Interest also has to be specified here on my bond. This is just pretend this is my bond certificate. Okay, and so we call this the stated interest rate, this 6%. And Victor Newman will pay this back. I don't know. Let's give him 10 years. All right, so we call that the maturity date. Matures October 13th. Oh, 10 years. Okay. So it's going to issue it today. It's going to be good for a whole 10 years. And interest is generally paid semi-annually. Actually, almost always. Okay. So, yeah, it's a certificate that shows interest rate. We also call that the face rate or the coupon rate or even the stated rate. It shows the principal. That's the $10 million here. The maturity date, when they're going to repay, when Newman Enterprises will repay all of their bondholders, and when they're going to pay interest. Okay. Before they do this, though, they were going to issue a prospectus, and I left mine at home. I had one from last year. My dad likes to, he's an active investor. And it's quite thick. It's this legal contract that says, yes, we're going to borrow money from you, and you can expect interest at this rate on these days. Okay. When they set this interest rate, what they're hoping to do is match the market. Right. So they're saying Newman Enterprises needs $10 million for an expansion, wants to expand into, where is it lately? Japan. He's got some business there. And he's looking at the market. He's saying, yeah, investors are looking for a 6% return. They do their best estimate as to the market and what people would expect from Newman, depending on their riskiness. Right. Now, they issue the prospectus, and there's many weeks are going to pass between issuing the prospectus and actually issuing the certificates. Okay. So when they actually get to sell these bonds and try to issue them to everybody, things are going to change. The market rate will have changed at that time. Okay. So there's going to be two different interest rates that we're going to look at. One, the face rate or the coupon rate, that's what we call this, right on the certificate. Okay, is what they had estimated a number of weeks ago. Okay. When they go to market it, there's going to be a different interest rate in effect at that time. Interest rates always fluctuate slightly. Okay. So we call that the market rate, the yield, or the effective interest rate. Okay. So the interest rate the bond will yield after selling at a discount or premium. Right. So Victor Newman has thought 6% was a good rate of return whenever he started this whole process a number of weeks ago. Gets to the market and somebody says, I don't want 6% anymore. I want 8%. Okay? And he's saying, but I can only give you 6%. And what are the investors going to do? What are the future bondholders going to tell him if they want 8% and that's the market? Are they going to buy his bonds? No. They're going to say, no. We're going to go elsewhere where we can get 8%. You're 6%. Not so good, Victor. So Victor's going to come up with a scheme. He's going to say, what if I can give you an 8% effective return? Okay, I know that the bond says 6%. I will pay 6%. But I'll sweeten up the deal here so that effectively you earn 8%. Okay? What do you think he's going to have to do? Will he be selling it for $10 million? Below 10 million or above 10 million? If he wants to sweeten it up. Is it above? What do you think? What will he effectively have to do? If people want to earn 8%, and this says only 6%, he's going to sell it at a discount, actually. Okay. It's hard to explain because I'm not teaching it the way I normally teach it. So I talk about all sorts of things like present value. Okay. Let's try it another way. The face rate is 6%. Okay, the market rate at the time that Victor goes to the market is 8%. He's got a stack of bond certificates like this, and he's saying, anybody want to buy a bond for 6%? And they all say, no way, Victor. The market is 8%. Okay? If he sold it at a discount, let's say $9 million, okay, and he said, effectively, you're going to earn 8% because I'm going to pay you $10 million in 10 years' time. Okay? You pay $9 million today, okay, for this bond that says $10 million. You'll be effectively earning 8%. Okay? Because I'm going to pay you $10 million, remember, in 10 years' time. Okay? If he sells it as a discount, people will effectively earn 8%. They'll continue to get 6% interest payments every 6 months. But because he's saying, pay $9 million today for something I'm going to give you $10 million for in the future, because we know that interest accrues and whatnot, they'll effectively earn 8%. Is that making sense? If he discounts it, okay, people will then say, okay, well, that's a good deal, because I see now that I'll actually earn that market rate of 8%. Okay? Yeah?
Now, a $10 million bond, that's not a realistic.
Oh, it's going to be many more millions than that, like $500 million. Yeah, so I had my perspective here. It was the CIBC bond issue, so CIBC was looking for some extra bonds. I think it was a few $100 million worth of bonds. Okay. All right, so it will sell at a discount. Okay, and oftentimes here, we'll say the price is, I don't know. It'll just say price is equal to 90, which really is a percentage. 90% of 10 million. Okay. Prices are often quoted. If you go online, check out some bond prices. You're going to see, oh, we're selling at 90, we're selling at 102, we're selling at 97. What they're really meaning is it's a percentage of the face amount. So for Newman, he had $10 million face on his bond certificate here. That's what the bond price is being the price is being multiplied by. Okay. Great. So let's take a look at the opposite. Okay. Victor Newman has got his bonds, $10 million face value, meaning he's going to pay back $10 million in 10 years' time. He's going to give everybody 6% per year, paid semi-annually. You know, matures October 13th, 2020, 10 years from now. All right. He prepared these bond certificates a number of weeks ago. He thought market rate was going to be 6%. He gets to market, and things have changed. He wants to sell all of his bonds now. And his face rate is 6%, but the market rate is 4%. Okay? Investors are only looking for a 4% return. He comes up and he says, anybody want to buy my bond? Any takers? Is there any takers? What do you think? Is it going to be easy for him to sell his bond? Oh, yeah, really easy. They're going to say, that's a great return, Victor. I'd love to buy some of your bonds. All right? So when the market rate is below the face rate, what Victor can do now is instead of selling it for $10 million, he can ask for a premium. He said, yeah, you want my 6%? It's going to cost you. All right? We call that a premium. We'll sell it at a premium, so that the bondholder will effectively earn the market, the 4%. Okay? Because Victor's no fool. Hey, he's been in business for a long time on Young and the Restless, right? So, you know, he's saying, okay, I'm not going to pay 6% if I don't have to. I'm going to pay 4%. I'm going to pay the market rate. And the way I'm going to do that is by selling it at a premium. Effectively, my bondholders will only earn the 4%. Okay? They'll pay $11 million today, and I'm only going to give them back $10 million in 10 years' time. Okay? See how that works? We call that selling at a premium. Okay. Now, in an ordinary financial accounting class, we'd actually calculate payments, and we'd calculate the prices, and this would take a whole class, but In this class, this is completely different for me. I'm only going to say that about bond issuance. Okay? Because what we're going to deal with is where the coupon and rate is the same as the effective interest rate, where the stated rate, let's go back here to Newman, this face rate, this coupon rate, this stated rate is the same as the market or the effective rate. Victor estimated market would be 6%. He put that on his shares, bond certificates. He sells them. Market is still 6%. Okay, and at that, when that happens, he will get only $10 million. He'll get exactly the face value here of the bond. Okay. So, in my example, assume that a business issues $100,000 of 12% bonds that mature in 5 years' time. The coupon rate is the same as the effective interest rate. Okay. So whenever they are issued, we're going to ignore the semi-annual interest payments for now. The cash will go up for this business, $100,000. Be issued. What they say is that it's issued at par. It's issued at 100. Okay, that would be the bond price. And bonds payable is also going to go up for this company by 100,000. So bonds always pay interest semi-annually. Oh, sorry.
I'm just wondering what benefit does it offer the bondholder to buy at a premium for only making the same interest anyway?
Yeah, and that's up to the individual bondholders to evaluate. There's other things that go on here whenever bonds are being sold. Is somebody, the bondholder, and a whole lot of interested people will look at, is Newman good for paying us the interest for that long? So risk assessment comes into play. And so, a company that's really risky might issue bonds, but still investors are going to shy away because they don't expect that they'll ever be paid the semi-annual interest or the principal amount at maturity. So, or they'll take, so they look at bond rating. So bond rating agencies look at this and they say, okay, Victor Newman, fairly stable, he'll pay you back, don't worry about it. So, and then other things come into play. As an investor, what's my time horizon? Is it 10 years' time that I'll need my money back? Is it 5 years? So, it sort of has to fit into the plan of that person too, and their risk tolerance. Okay, so that's what's going on. And, it's not to say after somebody buys Newman Enterprises bond that they can't sell it too. That there's this aftermarket that goes on. Right? So just because you bought Victor Newman's bond today doesn't mean you're going to keep your money there until October the 13th, 2020. You can sell it to somebody else. And that happens all the time. Okay. So at the Horticultural Council and even at the Agricultural Institute, we have a big bond portfolio in each one of them. So we've got extra money, and some of it's used for research. We only use the interest for research. We're buying and selling all the time on that. Yeah, certainly. Okay, so we're looking at recording the bond issuance at par when the market rate equals the stated coupon rate. Okay, so we're going to get an extra $100,000 here for this company. Okay, now this company does have to pay semi-annual interest payments, and how do we do that? We look at here again the formula for simple interest. Okay, interest is equal to principal times rate times time period. So every 6 months, okay, they'll have to pay $100,000 times 12%. That's the stated rate. But because that's a semi-annual interest payment, meaning it's only going to happen every 6 months, we only need to look at half of that interest. So that's $6,000 this company has to pay to all their bondholders every 6 months. So do I have that? There we go. The additional entry here is for the semi-annual interest payment. We calculated the $6,000. Cash is going to go down, and so will retained earnings. And eventually, they'll repay this amount at maturity. Okay, so when that happens, they'll repay their bond investors $100,000, and bonds payable go down $100,000. Okay. Another entry that I don't have written down here could be the accrual of interest to year end. So let's say the semi-annual interest payment doesn't exactly line up with the end of the year. Okay? So they might take a look at, they should, record interest between the last interest payment and the year end. Okay? So it could be for just a portion of the year. Okay. So let's say the last bond payment interest, bond interest payment was, I don't know, October the 1st. Their year end is December the 31st. Okay? They might want to accrue interest in between these interest payments. Okay? And so at this point, what do we have? We have all of October, November, and December. For 3 months. Okay? So again, we're going to use the same formula as what we saw here for simple interest to determine how much interest is owed or outstanding as at December the 31st. So principal times the interest rate. In this case, it's just 3 out of 12 months. Okay, so what is that? It's 3,000. Right? So then they would, on December the 31st, record interest payable. That would go up. And retained earnings would go down because of interest expense, so minus 3,000. Just to make that adjusting entry. They want to show that, yeah, we do owe our bondholders here a bit of interest. Okay. Yeah, I talked about that. We sell at a discount whenever the market rate is greater than the contract rate. Bond buyers are not willing to pay the face value for the bonds. And we pay a premium when the market rate of interest is less than contract rate. Okay. So there was something on the CNOW quiz. I think is it number 2? What is this one? That's their bonds. Okay. So you're asked to prepare the entries for bonds. Okay, so very similar to what we've just done. They issue the bonds at their face amount. We've done that in a previous slide. They pay the interest on the bonds. Okay. The other thing to keep in mind, too, is that whenever bonds are issued, that's a financing activity. Anything related to long-term liabilities, shareholders' equity, is a financing activity. When they pay the interest, though, that's an operating activity. That I did not mention. Oh, and then here they're recording the accrued interest. So very similar to that last piece of paper there. Okay. So, yeah, so they've issued $24 million of 20-year, 10% bonds on April 1st at their face amount. So very similar to the slides that we just went through. Okay. So you will need to refer back to these slides here. Okay. That's the issuance of bonds. That's the first part of the CNOW quiz. The semi-annual interest payment. Okay, and there was an accrual of interest in between interest payments. Okay, so between October the 1st and April the 1st, the following year, there was a year end. Okay. Oh yeah, and there was an interesting article. I keep all these old Citizens. So that's the Ottawa Citizen. Okay, so this is from Thursday, September the 30th. Do I have the right one? I do. Okay. So, yeah, so that's the business section of the Ottawa Citizen. And there's always this thing about personal investing. Okay, so FP investing is from the Financial Post. The Citizen's affiliated with the Financial Post. And they talk about, what happens to bond prices when the market rate of interest changes. That was kind of interesting. Okay. So, I was talking about provincials and corporates. What are they talking about there? They're talking about provincial governments issuing bonds, because that happens a lot. Okay, so, Government of Ontario needs extra money for whatever, a new hydroelectric dam, or to pay for whatever, a light rail in Ottawa. They're helping to fund the light rail in Ottawa. They might issue a bond because they don't have the available cash, right? Or corporates, meaning corporate bonds. So like CIBC issues bonds because they want to raise some extra capital for whatever reason. Okay? Or you're Terry Matthews and you want to expand. You might issue a bond, okay, out of one of your companies. So what is it talking about here? So after the Bank of Canada hiked interest rates again this month, so when the Bank of Canada increases interest rates, that's the market value of rates, right? So when market rates go up, the third increase since the spring, right? So that's that is significant, investors may be wondering how safe their bond portfolios can be in a rising rate environment. Okay, because the prices, look at this, we've established that prices will affect, are affected by the market rate of interest. Okay, so if the market rate of interest keeps going up, okay, that bond will sell at a discount. In existing bonds, the prices will go down. When we say discount, prices are decreasing. Right? And that's what's been happening. Investors may be wondering how safe their bond portfolios can be in a rising rate environment. Conventional wisdom suggests that as interest rates rise, bond prices fall. Okay, and that's exactly what I'm talking about in this slide. Okay? If the market rate of interest is greater than the contract rate, so if the market rates keep going up, bonds get further discounted. Okay? Their market prices too go down. Okay? So bond prices fall, and bond investors will face capital losses. So they thought they had something worth, so many millions of dollars, but now it's worth less. While that's true, investors often ignore the divergence in performance that can occur between a short-term bond and long-term bonds, says Christine Harowski, head of fixed income at Orion Capital Management. Okay, so actions from the Bank of Canada impact short-term bonds the most, and investors' expectations of growth and inflation influence yields on longer-dated bonds, said the portfolio manager. Anyway, so it just goes on just about an investment strategy there between your short-term and your long-term bonds. But, it sort of reinforces what we've just learned. Market rates go up, bond prices generally tank, okay? They're sold at even a larger discount, okay? And so the converse is true. Market rates fall, okay? Your bonds are going to be worth more, okay? They're going to be selling at a premium. Okay? That's what I mean to say. Okay, so we'll look at a problem from the book. Sierra Vaults Corporation produces and sells burial vaults. Oh my goodness. I guess somebody's got to sell those things. On July the 1st, 2010, Sierra Vaults issued $18 million of 10-year 6% bonds at par. Okay, and when I say at par, they sold exactly for $18 million. Interest on the bonds is payable semi-annually, December 31st and June 30th. The fiscal year of the company is the calendar year. So illustrate the effects of the issuance of the bonds on July 1st, 2010 on the accounts and financial statements. All right. I was talking to a coworker on the way here, and she said, "Do you find this gets tedious after a while, going back to the accounting equation? Because I can't say the word debit or credit." And I said, "Yes, it does." Okay, so when bonds are issued, what happens to the accounting equation? Do any assets go up? What do you think? Are they going down? What's happening? Let's hope they get some cash, right? Cash is increasing. Liabilities will also increase, so our bonds payable. Right. So they're also asking what happens to the financial statements. Well, nothing's going to happen to the income statement because we haven't affected retained earnings account. We have affected the cash account, and we know that that ties into the statement of cash flows. This is a financing activity. Right? Anything to do with long-term liabilities, shareholders' equity, generally a financing activity. Okay. What's next? Illustrate the effects of the first semi-annual interest payments on the December 31st, 2010 on the accounts and financial statements. So let's just calculate that out, though, first of all. Semi-annual interest payment. Well, I'm going to have to go back to my formula for simple interest, which says multiply the principal times the stated interest rate. What are you here? 6%. Times the portion of the year, the time period. Okay. This is semi-annual, so I pay this interest every 6 months. So I'm only looking at 6 over 12. So they pay their bondholders $540,000 every 6 months. So exact requirement, though, was illustrate the effects of the first semi-annual interest payment on December 31st. Well, like cash is going to go down. The other side of it. Is bonds payable? Are we paying down the principal of the bonds?
Retained earnings.
Retained earnings, that's interest. Yeah. So interest expense has the effect of reducing retained earnings. Okay, so on the income statement, interest expense here is going to be affected, $540,000. On the cash flow statement, this is actually an operating activity. Okay, just the payment of interest. We consider that an operating activity. Right. Illustrate the effects of the payment of the face value of bonds at maturity. So it's many years later. What was it, 10 years? 10 years later, right? That's what it says. When they say it's a 10-year bond, it means they're going to repay it in 10 years. How does that affect the accounts and the financial statements? Okay. Well, they have to pay back their bondholders $18 million. Okay, they're paying the principal. That's what's happened. And it's at this point where bonds payable will go down. It doesn't go down before then. Okay, so there's no effect on the income statement because there's nothing here under retained earnings. The cash flow statement is going to be affected. This is a financing activity. Okay, because we're repaying the principal of a bond, and that's a long-term liability. Any questions on that? Okay. It's similar to your See Now quiz. Okay. So the last question. If the market rate were 7%, okay. Remember what did they say here? What was the rate here? It was 6. The stated rate or the coupon rate. It's unfortunate that we have to use all these same words to mean the same thing. The stated rate, coupon rate, we all mean the same thing. What's on the face of the certificate is 6%. Market rate is 7%. It's going to be really hard for whatever this company is, Sierra Vaults Corporation, to sell their bonds. Will it sell at a discount or a premium? Discount, right? So the market rate is higher than the stated rate. Discount. Okay, so Sierra Vault will say, you know what, you'll effectively make 7%, we'll charge you less. Because you're going to be earning more until maturity. All right, well that's a good point to have a bit of a break. I've got 10 o'clock, so why don't we come back at 10:15. We'll get back to it. I had a lot of questions during the break about last week's quiz, or the quiz that closed anyway last night at 11:55 p.m. So I thought I'd go through it. I do set it so that you can be plus or minus 1 or 2% off in your answers, but for some people that just wasn't enough, so let me explain why. So the first problem is just calculate depreciation using two different methods. Okay, so the first one, you buy a tool sharpening equipment for $48,600, and I started to do the problem here. It's got a useful life of 3 years, residual value of $3,000. Calculate straight line, and that wasn't a problem for most people. They're able to do that, right? So 48,600 minus 3,000, divide all of that by 3 years, and you get the same amount every year, except for the first year, because I think you're buying it. Yeah. So it's $15,200 a year, but because in 2008 you buy it on July the 1st, you're only going to put half in here, right? So whatever that is, 7,600. Anyway, so you just keep going. 200? Yeah, because there'll come a point. Oh, 15,200. Yeah, I'm putting in the wrong amounts. Anyway, so it's fairly straightforward because it's straight line. 3 years. Oh wait, that means in this last year I'm fully depreciated halfway through. The part that caused a little bit more difficulty was B. Okay, so calculate depreciation expense using the double declining balance method. Right? So in 2008, and I've detailed it all out here, that we bought it halfway through the year, so it's a little bit more complicated. We take 48,600, the original cost. The straight line rate is 1 over 3, because it's for 3 years, but then we multiply it by 2. So I'm just going really quickly here. And we only used it for 6 months out of 12. Okay, so the calculation for that year, 16,200. Okay. In 2009, remember this is the one where you have to always calculate, well, what is my new net book value? That's the original cost less the accumulated depreciation. So at that point, it is whatever it is, 37 something. 32.4. And the other thing to keep in mind is to try to keep as many decimal places in your calculator. Okay, so this rate over here, it's 2 over 3, which is 66.666666, whatever. Try to keep as many of those decimal places in there, okay, because it will make a difference on a number that's this large. You should get roughly about 21,600. I had, I think, a millionth of a penny, mind you, but I knew to round it to 21.6. Okay, so that was causing some people to get numbers that weren't right. In 2009, what is depreciation that year? I have to take the original cost, subtract out all of the depreciation from the previous years, and again, try to keep as many decimal places as possible. What you could do is just multiply by 2, divide by 3. You'd get it perfect. You get 7,200. So in 2010. The difficulty was in 2011. That posed another challenge for everybody. Remember, we can't depreciate below the residual value. That's where that $3,000 comes into effect. Okay, the residual value is $3,000. So far, if I take a look at my accumulated depreciation account, I've got a balance here of $45,000. I'm getting really, really close to $3,000. Right? My net book value at this point, my cost is $48,600. Accumulated depreciation is $45,000. It only leaves $3,600, and I can't depreciate below residual value of $3,000. So even though my calculation was telling me, oh, multiply that by 66 2/3% and get depreciation expense of $2,400, I can only use $600 of it. Okay? I can't write that down below $3,000. So that was part of the challenge there in that problem. Okay. Everybody, I know a few people were saying, oh yeah, I had that problem, So yeah, thing one, try to keep as many digits in your calculator as possible. I do set it that I do accept, you know, a range, plus or minus. I've got a default at 2%, but you know, after 1 year after another like this, if you've made an error from 2009, it does carry forward into 2010. And so that's a lot of email was coming in. I was right in 2009. What happened in 2010? And the other one was the final year's depreciation. The second question, there was a typo. I did announce this thing the end of class last week. I'm not quite sure everybody heard me. And I also put an announcement on WebCT. This should have read that they sold it on April 1st, 2011. So you've calculated straight line depreciation to December the 31st, 2010. Right? So that was easy. Add another 3 months of depreciation. This should have been 2011. That's the problem there. So the first step was bring the depreciation up to date. That's what they're asking for. Illustrate the effects on the accounting equation. Then, assuming, I've increased my screen here so I can't read the whole thing. Yeah, so the first part is depreciation for the first 3 months until the sale. I hate how this thing scrolls. I've got to go back here to scroll it. And then assume that they sold it for $315,000. Illustrate the effects on the accounts and the financial statements. The other problem that was happening here is not everybody could see liabilities plus shareholders' equity. And I realized that was a problem. And I posted an announcement on WebCT. Try to open up this assignment in Firefox. Okay? And make sure as well, I phoned the technical support people. They said make sure all the components are installed because you need Flash, Adobe, and whatever. Run a system check. Make sure you've got all the components. Okay, so you might just want to do that now, even if you didn't have a problem, because there might be a problem in the future on one of the quizzes. So run a system check. What this does is just check to make sure you've got Shockwave and PDF in all of these. Okay, so that might have caused that problem as well. But if it still wasn't showing up, the other thing to do was to open up the assignment in Firefox. It just seemed to be a Windows Explorer thing. I don't know. They couldn't figure it out at Cengage now. All right, so that would make all this other stuff appear over here. All right. So that was last week's, which I know that was last week's, but it's still good practice for the midterm. Okay. I should get back. Where are my assignments? I think this week's quiz is the one that you're interested in. And we've taken a look at 2 of the questions, and we'll soon take a look at the last one, which is question number 1, oddly enough. Okay. There we go. All right, so we looked at liabilities. All right, we have a better appreciation of what amounts we have to put in there. Let's take a look at shareholders' equity. Okay. And again, the textbook is really skewed toward American legislation. I'm going to tell you a little bit more about how we do it here in Canada. Right? So let's just give us some background about, how do we form a corporation in Canada. So we look to a piece of legislation called the Canada Business Corporations Act. Okay, so that is, if you want to do business nationally, you'd register under the Canada Business Corporations Act. And it's a federal act, but also provinces have their own, too. So Ontario will have equivalent legislation. Quebec has their own equivalent legislation in Manitoba, which they have their own little idiosyncrasies. Okay, but I'm going to talk about the CBCA, or the Canada Business Corporations Act. It's divided into 2 parts right now. Okay, Part 1 and Part 2. Part 1 is for corporations with shares, which is profit-oriented companies. Okay, Part 2 is for nonprofits, which is no shares. Okay, they're issued without shares. So let me write that down. So you've got Part 1 right now and Part 2. That is changing. Next year, the not-for-profits are going to be incorporated under another piece of legislation, right? So it's yet to have, hasn't been enacted fully, but we're getting there, right? So not-for-profits will now be scrutinized another way, right? So they have their own set of rules. And it's just a set of rules that we're talking about, what you can and cannot do, okay, as a corporation. Corporation is a legal entity, right? So it can borrow money. Right? It can act just like a person can. Right? And it can issue shares. So whenever you want to incorporate, you apply to Industry Canada, and they tell you whether or not you are in compliance with the CBCA. Okay? And you're going to give them your list of rules. It's like a constitution. right? It's called bylaws. And you're going to say, this is how we operate. Okay, these people are given these powers, and if we want to make this decision, this is what happens. And these are the people responsible for the corporation and whatnot. And Industry Canada will get back to you and say, yeah, that's okay. That's in compliance with the Act or not. Okay. And then if you're in compliance and you're applying, like I say, for incorporation, they'll give you a stamp of approval. Yes, you are now incorporated. Go do business somewhere. All right. There are two types of corporations as well. So if you're a profit-oriented corporation, you're issuing shares. You can issue shares to the public, in which case we'll call you a public corporation, or not. You can issue shares to just your close circle of family and friends, whatever you want to do, okay? A public corporation, if you want to issue your shares to just about everybody and anybody, you will generally list on a public exchange, okay? It's somewhat like the Toronto Stock Exchange. It is the only ones left in Canada. So here we go. This is the newspaper of today, the Ottawa Citizen. This is the business section. And we do see here under Ottawa Stocks that there are some public companies based right here in Ottawa. Okay, so you can today, if you'd like, buy a share of Beaufield Resources. And yesterday it closed at 39.5 cents. Okay. Maybe you'd like to invest in some Calian Technology. They closed at 18.46 a share yesterday. So a lot of these are small numbers, which generally isn't. Those are very high share prices. Massey Technologies, $27.25. A lot of these are small. And we'll notice here on the listing that it's telling us what the net change was from the previous day, the 52-week high and the 52-week low, just giving us a range, right? And so a company has issued shares, but then there's this aftermarket. That's what they're talking about here. Other people have said, okay, I did buy Dragon Wave, and now I'd like to sell. Okay, and there's this aftermarket. So this is on the Toronto Stock Exchange. And there's some other Canadian companies here of interest. Okay, so you might want to buy some Zarlink, okay, or some Astral Media, whatnot. And so it's telling you what they closed at yesterday. Okay, so, and this is, these are on the Toronto Stock Exchange. There's also American stock exchanges. Okay, so they've got the New York Stock Exchange, there we go, NYSE, and the NASDAQ. Okay, and they're telling you who got the biggest top gains yesterday. So if you're interested in that, this is the volume, okay, how many shares traded and at what close and if it went up or down. Okay, so even though a company might issue shares on an exchange, they'll tell the Toronto Stock Exchange, we'd like to issue shares on your exchange, there's this aftermarket, which is what this is reporting. Okay, existing shareholders saying, I'd like to buy more, I'd like to sell, okay, make some money. People like to make money that way, all right? And that's what they call a public corporation. Right? They are issuing shares on a public exchange. Anybody can buy them. Go ahead today, buy a share of whatever. Okay, you'd have to set up a brokerage account somewhere with a brokerage house. But you can. Anybody can, as long as they have the money. Right? That's what public corporation means. It also means they've got to show their financial statements publicly. They've got to disclose them. Right? So they will issue generally quarterly financial statements. Okay, and they are scrutinized by investors and Securities Exchange Commission and whatnot to make sure that, okay, is the company doing well? So financial statements, balance sheet, income statement, statement of shareholders' equity, statement of cash flows have to be shown on a quarterly basis. Okay? And they also get a lot more questions than a private corporation. Right? So you're going to have interested investors or investor houses quizzing the senior executives of these companies about their strategy and what they're doing. Okay? Private corporations don't. They're not issuing their shares on any exchange. Okay? There's no general aftermarket for their shares. It might just be a close-knit family. They're, okay, Rogers Communications. Yeah, a lot of Rogers family have shares in that company. Okay? Another, although they do have some shares that are also in the public corporation. A well-known private corporation here in town is Lee Valley Tools. Okay, so it's owned by members of the Lee family, okay, Leonard Lee. Okay. So that's a public corporation. Does Leonard Lee have to tell us how Lee Valley Tools is doing every quarter? No, he's not going to give you his income statement or his balance sheet. Okay, it's a private corporation. Don't have to. Okay, and that's entirely fine. He's still registered under the Canada Business Corporations Act or some equivalent provincial legislation, but it's not to say that he's got to make his books public. He's not on any one of these public exchanges. Okay, so what do we know about a corporation? As I mentioned, they're a separate legal entity, so they can borrow money, they can buy assets, they can do anything that regular people can. Shareholders are only liable, they'll only lose the amount of money that they've ever paid for the share. Okay, so it's not like the company, if the company were to not pay a bank loan, that bank would then go after the shareholders. That's not how it works. Okay, the bank is just going to go after the assets of the company, and that's it. You can't also go after the owners of the company, the shareholders. So the shareholders have got limited liability. They can only ever lose the amount that they paid for the share. They can transfer their ownership rights. So as I mentioned, this aftermarket. They can go onto the Toronto Stock Exchange and say, I would like to sell my shares of Zarlink. Okay, so they can transfer that ownership. Companies can acquire capital either by issuing more shares, issuing bonds. Okay, they can get a bank loan. There is no limit to its life. It's got a continuous life. So unlike a proprietorship, where if the business owner dies, there's no more business. With a corporation, doesn't matter if a shareholder dies, the corporation will continue. Right? Generally, we've got professional managers managing the corporation. We've got corporation management. They are subject to a lot more government regulation. Like I mentioned, their bylaws have to be approved by Industry Canada. And if they want to change those bylaws, they've got to go see Industry Canada again. It's a special arm of Industry Canada called Corporations Canada. And they are also subject to income taxes. Okay, so all those earnings, as we saw earlier in the lecture today, multiplied by the tax rate. Okay, and set up income tax payable. Okay. Shareholders can sell their shares. They have a right to vote. That's the biggest right that they've got. Right? So they'll go to the annual general meeting or other ad hoc shareholders meetings, and they'll be asked questions. Should we do this? Okay? And the shareholders get to say yes or no. They have that right to vote. And that's one of their rights. They may receive dividends, and that's a big may, because not all companies will actually declare dividends. Okay? So they pay, let's say you're Zarlink, you pay $2.16 for your share. You might expect a dividend. Maybe Zarlink will declare a dividend, and as a shareholder, you would get a little bit of the profit. Okay. Liquidation. Upon the right of liquidation, if that company ever gets insolvent and winds up, the shareholders, if there's anything left after paying all the creditors, are entitled to whatever's left. It's right of liquidation, which is probably not a lot. If the company is insolvent and is declaring bankruptcy, probably wouldn't be anything there for them. Right? But, you know, we're going to put that down as a shareholder right. Preemption, what that means is if, let's say you've got your Zarlink semiconductor share and you'd like to, they'd like to issue more shares. Okay? And you've got 10% of all Zarlink shares, and you want to maintain your 10% holding of Zarlink shares. You want to be that 10% owner. And Zarlink wants to issue more shares. You've got the right of preemption, meaning you've got the right to buy 10% of that new share issue, so that you keep and maintain your 10% stake of Zarlink. Okay? So they call that preemption. You don't have to, but you have that right to keep your same amount of shares. All right, so just some more terms to add to your ever-growing vocabulary. We've got shares of a company, right, traded on a stock exchange. The bylaws are going to tell us how many total number of shares can ever be issued in the life of this corporation. Okay, and they call that the authorized number. Right? So that's right in the bylaws. It's kind of like a little constitution of the company. So it'll say, okay, in total, there's 10 billion shares that could ever be issued. It's not to say that that many will be issued, just over its life. Okay. Oftentimes, what a lot of companies do here is this is unlimited. They'll just say an unlimited amount of shares are authorized, just so that they don't have to change their bylaws every time they issue shares. Then they will issue shares as time goes on. Okay. So issue 1 share here, 3 shares there, whatnot. And that is obviously different than the total amount authorized, according to the bylaws. Now, outstanding. That's the shares that are currently in the hands of the stockholders. And how would this be different than issued? Okay. Well, sometimes shares are bought back by a company, okay, for whatever reason. They're repurchased. So outstanding would be the amount of shares that were ever issued less the amount that was repurchased. And so outstanding is generally the smaller amount. Okay, so if we take a look at, this is a graphic from the textbook, which I thought sort of explained it well. Authorized is like the whole universe, right? Remember those sets that used to take in math? Issued is a smaller set within authorized, and outstanding is even a smaller amount of that. Anyway, I explained it well. Often companies have got two broad classes of shares, not all of them. Common shares and preferred shares. You're not going to see this with every company. Actually, by and large, the majority of companies just have common shares. Okay? So common shareholders have 5 rights of share ownership unless a right is withheld. For example, Rogers has Class A voting and Class B non-voting common shares. Okay, so 2 classes of common shares. One has got the right to vote at the AGM, but one, they've taken away the right to vote. Okay, so which ones do you think the Rogers family has? Class A voting or Class B non-voting? Your Ted Rogers family. Which class of... Yeah, you've got the votes. So the rest of us who want to buy into the Rogers communication empire, which one do you think is available to us? B, exactly. Okay. So if I go to the TSX, actually, what is it? Yesterday, I know Rogers is... Yeah. I don't know if you can see this. Find my thing. There it is. It's my finger. Okay, so I know this is where there's a wrinkle here and there, but I've put some red arrows beside Rogers Communication B, meaning Class B, and NV means non-voting. Okay, so this is the only class of Rogers share that you can buy on the TSX. Right? It would have to be the non-voting. Darn, you don't get a say into the affairs of the Rogers Communications kingdom. You get Class B. Class A are for the family. They get to vote. They control the company. Right? And we see that at other spots here too. I don't know if you can tell. Reitman's is up here, and it says NV as well. Okay. You see Reitman's A, NV. It's a non-voting share. They've taken away that right from those shareholders. Okay, and that happens often. We've got Canadian Tire A and V, non-voting. Well, somebody else has got the voting rights. All right. So, yeah, Shaw Communications Class B, non-voting. That's another one down here. Shaw Communications. It's a communication company in the West. All right. So, by and large, most companies have got, all companies have got common shares. About a third of Canadian companies will also have a broad class of shares called preferred shares. Okay, and it offers a little bit more entitlements, like they will receive dividends before common shareholders. Okay, so if companies got both preferred and common shares, they declare a dividend, so preferred shareholders are going to get it first. Whatever's left goes to the common shareholders. And as well as should the company be dissolved for whatever reason, preferred shareholders would receive whatever's left, the assets, whatever assets are left before the common shareholders. They also have some features which the textbook doesn't go into much detail on, but cumulative, meaning the dividends may be cumulative. So if they don't declare dividends one year and you're a preferred shareholder, next year you're going to get twice the amount of dividends. So the dividends will accumulate. You can convert them, the option to convert them into common shares or bonds, or they could be callable, meaning the company can just call them back, buy them back. No par value. This is where we really get diverge from the textbook, right? Because the textbook talks a lot about this par value. Okay, older corporations will have par value. It used to be had a legal definition. Okay, it's a nominal value that was per share that was established according to the Articles of Incorporation or the bylaws. This is for only companies that issue shares before 1985. Okay, so that's why we see, by and large, in Canada, there are no par value, okay, assigned to common shares. Right? So yeah, it was just a sort of legal concept. It was in the Canada Business Corporations Act. They took out those clauses after 1985. Okay, so right now, a lot of shares are no par value whatsoever. Shares before 1985, you'll actually see a value in the description of the share. So for Rogers, they've got 1.4 billion authorized Class B non-voting shares with a par value of, and I don't know how they calculated this. This is ancient history, I guess, for all of you. $1.62.4778 per share. Okay. We don't have that anymore. And oftentimes, what we see besides share descriptions is just NPV, no par value. Right? And they've taken it out by and large. You don't see it much anymore, NPV anywhere. I don't see it on any one of these. But in the States, certainly, you see par value a lot. Okay. Not here in Canada. Okay, so we've talked before in previous chapters about issuing stock, companies issuing stocks. Okay. But the actual price at which the stock sells will depend on a variety of factors, basically the market and how the company is doing and the investor's expectations. All right, so Chancellor Industries issues 2,000 shares of common stock, and Catherine Chancellor gets $55 per share based on all of those factors. Okay, so that means Catherine Chancellor gets $110,000 for her company. The entry that she's going to make, not new to us because we've seen it before, is that cash goes up by $110,000 and the capital stock account goes up by $110,000. Okay. Not new. Right? However, instead of cash, Catherine Chancellor could also accept other assets. Okay, this is a new concept. This is a new type of transaction. So Chancellor Industries issues 2,000 shares of common stock for equipment with a market value of $110,000. Entirely possible. Okay, so what we're going to do is take a look. Hopefully we have the market value of the equipment. That's the number we're going to, if we're given two numbers, we'll go first with the market value of the equipment. If we don't know the market value of the equipment, then we'll take the market value of the share. All right. But because we've ascertained the market value of the equipment to be $110,000, that's the number we're going to put here into the entry. Equipment goes up instead of cash, $110,000. Capital stock goes up, $110,000. Right. Another transaction we've not seen so far is a repurchase transaction. Oh, goodness, it's not. Here we go again. My screen's all mixed up. I know if I come out and come back into it, I'll see it. There's some. There we go. Okay. Sometimes a company may want to buy back their shares. Sounds a bit odd, eh? So company's gone great lengths to issue shares, right? Catherine Chancellor issued shares for $110,000 she got in cash. But she might want to repurchase them. Okay? Which sounds a bit odd. Why would she want to do that? The company has to go out on the open market. They have to pay whatever price here that we see listed on the public exchange. They don't get a break. Okay? They have to pay. You know, if it's Rogers Communication, Class B, non-voting, they have to pay $40.15, okay, if that's what Rogers would like to do, to repurchase their shares. Okay. Why would a company do that? Do you have any insights as to why would they want to repurchase their shares? Yes? Sorry, I can't hear it. The shares are going up? Okay, so if they repurchase it, what do they hope to do? I think it's almost the opposite, eh? If the share prices are going down and they repurchase, anybody remember the rules of supply and demand? Anybody taking that? Yeah. If the price is going down and a company repurchases the shares, what's happening to supply? Yeah, you're restricting supply. What's going to happen to the price? And this happened last year. Research in Motion did this. Last year about this time, actually. Okay, so there was some reports coming out in the newspaper, and you know, you read anything here about anything happening with profit or whatnot, Where is it here? There's nothing going on. If you see anything in the newspaper about, oh, the sales are going up, well, here's one. So this is the Citizen from September the 30th. Thermal energy Q4 sales are heating up, okay? The markets and investors are really sensitive to these sorts of reports in the business pages. Or profit is up at AGF Management by 22%, okay? So as soon as you hear that, oh, this is more than expected, or, you know, you're going to see the price, the share price, also go up. Okay? If you see good report earnings, it's greater than expected, showing record profits or whatnot, you can almost guarantee that the next day in trading that the share price will also go up. Okay? They're very fickle like that. So what was happening with Research in Motion is that the profits came out. They report their quarterly profit, okay, Q3 or third quarter, that's what that means, profit. And it was less than expected, or maybe it's even a loss. What tends to happen after those sorts of reports is share prices go down. And so, you know, Jim Balsillie at, Research in Motion in Waterloo is looking at that and he's saying, oh no, you know, my shareholders are going to be so disappointed. Our shares are going to react to this earnings report. Okay, so he bought back some shares, and that made the price go up a little bit. Okay? And that's kind of artificial, eh? Anyway, but it's done. Now, in Saskatchewan only, I believe, a company can repurchase stock for reissue later. They call those treasury shares, and it's only in Saskatchewan and maybe one or two other provinces that are allowed to do that. But not under the Canada Business Corporations Act, and certainly not under the Ontario legislation is that allowed. Okay? So you can repurchase stock with the intent of reissuing it, but by and large, if stock is repurchased, it's canceled. It can never be issued again. Okay? So the transaction I'm looking at here for repurchase is that they have stock has issued some shares and then repurchase and cancel those shares. Okay? So in this case, repurchase 1,000 shares at $10 each. The book value was $10. I'm making this a really simple transaction. Therefore, cash is going to go down, capital stock is going to go down. So the question becomes, how did I calculate book value? I took a look at the balance of the common shares account divided by the number of outstanding shares. Yeah?
So you said that it cancels the share once you repurchase it.
Yeah, under CBCA and many provinces' legislation. They have to cancel.
I thought that you could issue an unlimited amount of shares.
Yeah, exactly. Just issue some others. Yeah. It could be that the shares are in short supply and they've got to honor maybe some employee purchase plans, like that was mentioned earlier about employees buying it. And so they might be coming up close to their total authorized, and so they might want to have treasury shares to reissue later in that case. Okay. Because to reissue get your articles of incorporation changed is a big deal. To go back to Industry Canada and change all that. Anyway. But treasury stock, like I say, by and large, there's only a select number of provinces where that's actually allowed. Most of the cases of repurchase stock, they're canceled. Right. So, cash dividends. Companies don't have to declare dividends, but they might want to in order to please their shareholders. All right. So often what happens, you see these earnings, okay, AGF Management, these earnings reports, they say the profits are up 22% in the third quarter. And what will go with that is the quarterly balance sheet, income statement, all of that. And they generally declare dividends. Okay, if a company is going to be declaring dividends, it's on that basis. Okay. And by and large, most of them are cash. Okay, so that's the most common form of dividend would be a cash dividend. And there are three conditions. You need enough retained earnings. So you can't make retained earnings go negative. Right? Not a good thing. And you have to have sufficient cash. Sounds obvious. And you need a formal action by the board of directors. What does that mean? They have to declare the dividends. They have to have a meeting, and everybody's got to vote yes in favor of the dividend being declared. And it's often in the form, the dividend rate is, we'll say, oh, no, that's not right. Go back. We're going to declare dividends, and everybody gets so much per share, 50 cents a share. Okay, or $1 a share or whatnot. So if you've got one share certificate, you get that $1. You get one share certificate, you get that 50 cents. There are 3 dates when we talk about dividends. The date of declaration, board of directors gets together, they declare dividends on October the 1st. But they're going to say it's not for shareholders of today, October the 1st. It's shareholders of record November the 10th. It's usually in the future. Okay? Sounds kind of odd. Why not today? So what's going to happen between October the 1st and November the 10th? People are going to be scrambling, saying, oh, if I get that share, I'll be entitled, if I buy that share, I'll be entitled to that dividend on November the 10th. Okay. And then you've got the date of payment. So they generally have what's called a stock and bond transfer agent. They're run out of banks, used to be run out of trust companies, who will take a look at all the registered shareholders and issue the payments on December the 2nd. Okay, so actually it's strange to think companies don't maintain a listing of their own shareholders and who's got so many shares of whatnot. They tend to outsource that to stock and bond transfer agents, and they're the ones issuing the checks. So as an example, November 23rd, Jabot Cosmetics declares $1 per share cash dividend for those shares on record December the 15th. It's always in the future. Kind of strange. Payment will be made December the 24th. There are 20,000 shares outstanding. So on the date of declaration, that's November the 23rd, we actually prepared an entry here on the books. Okay. We're going to reduce retained earnings. We know that dividends do affect retained earnings. We're going to reduce that. And dividends payable, we're going to recognize that. That's going to go up. Okay. It's reliable now. We've got a liability to pay for these dividends. Now, December the 15th, that's the date of record. There's no entry. Does not make any difference here. And then the date of payment, December the 24th, we'll pay our liability, so that's going to go down, and so will cash. Now, some companies don't issue dividends, ever, right? So, you buy a share of whatever, and you certainly hope that you get a dividend, and you probably build that into your expectation of the price, okay? But companies are not obligated to declare dividends. So if a company is growing especially, okay, they might not want to declare dividends because that's going to take resources away from the company. Okay? They're going to have less cash and have less retained earnings. Why would they want to do that? Okay? WestJet has never declared a dividend. Okay? So if you own a share of WestJet, don't expect a dividend. Okay? So if you're a shareholder there, you're hoping just to make money from share appreciation, okay, that the price will go up. You hope. Another transaction that we see in shareholders' equity are for stock dividends, okay? Which again, this is a very rare thing to have actually happened. Instead of getting cash, they're going to issue you more share certificates. You're going to say, okay, you're a great shareholder. We're going to, instead of giving you cash, how about some more shares? So let's see what happens whenever a company declares a stock dividend. Generally, it's expressed as a percentage. So they'll declare a 20% stock dividend. So if there's 1,000 shares outstanding, they're going to issue 20% more. So an additional 200 shares are going to be issued. Okay, so we just multiply here. So we're going to increase the number of shares by 200. Okay, so what does that do just by itself? If you used to have 1,000 shares outstanding, you now have 1,200 shares outstanding. What's going to happen to the share price? It's going to go down, yeah. Are you going to have happy shareholders? No. So already you can see how some shareholders might not appreciate a stock dividend. The other thing about stock dividends here is that they are taxable. Okay, so have you given your shareholder any cash to pay the tax? No, you gave them some nice shiny new share certificates. Thank you very much. So that's why you don't see stock dividends very often. Anyway, but the entry to record it is you take the number of new shares, which in this case is 200. We're going to multiply by the current market value. In my instance here, it's $20 a share. So retained earnings is going to go down by 4,000. And I'm going to create a liability account for the stock dividend distributable, meaning I will eventually, I'm liable to issue these extra shares. Okay. And then whenever I actually issue them on the date of distribution, I will issue the capital stock, $4,000, and my liability will go down. Okay. But like I say, it's not as certainly not as common as cash dividends, okay, because you're going to end up with a lot of unhappy shareholders here. They're taxed on a dividend they have no cash for. and their share price has gone down. Anyway, this is a more common transaction, is something called a stock split. Okay, so all that's going to do is increase the number of shares outstanding. So how does this work? If a company issues a 2-for-1 stock split and they had 20,000 shares outstanding at that time, after the stock split they're going to have 40,000 shares. So you get 2 for 1. Hand in that 1 share certificate, it'll give you 2. That's what's going on here. Just doubling that, the number of shares outstanding. What's going to happen to the share price in a 2-for-1 stock split? Yeah, cut right in half, exactly. All right. So if all other factors remain equal, okay, in the marketplace, and the only thing that we change is the number of shares outstanding, our share price will go down. Because remember the laws of supply and demand, and they cross. There's no entry in the accounting system for this. You're just increasing the number of shares outstanding. Why would a company want to do that? Where is it? I was reading in the paper today. There it is. So this is today's business paper from the Ottawa Citizen. It says that Apple shares, okay, you read that there, they are at $300 US. They've cracked the $300 US mark. Apple shares broke through the $300 US mark to hit a new record Wednesday, powered by booming sales of the iPad and the iPhone. So those of you who've got iPads and iPhones, Apple thanks you. Apple shares were up 94 cents per share at $301.35 US about an hour after the opening bell on Wall Street. This would have been yesterday. Apple is to report its fiscal fourth-year quarter earnings on Monday, and analysts are predicting another blockbuster quarter from the maker of the Macintosh computer, iPod, iPhone, and iPad. What generally happens when a share price gets that high, and that's trading just a bit too high for a lot of shareholders, because you don't just buy one share, by the way. You buy a block of them, is most likely they'll do a stock split, okay, just to bring the price down, to make it affordable for more investors. Okay. They might not, though. Okay. There's a company that's been around for a long time now whose shares had trading at a even higher than Apple. There it is. And that's Google. Okay. So if you want, it's an American company. You can go on to NASDAQ. They're traded on the NASDAQ exchange under the ticker tape symbol GOOG. Okay. This is where they're trading at 10:14 a.m. Actually, maybe I'll refresh the page. Oh, okay, there we go. I just refreshed it. 10:57 a.m. They're trading at $542.10, which again, that's really high. Okay. They're telling us a little bit more too about where the high and the low have been over the last year. It traded at a low of 433, high of 629. Right, so 541, still rather high. A lot of people say that they should have a stock split to bring the price down, make it attractive for investors, because you're going to be buying a block of them. Every investment house is a bit different. But, yeah, that's interesting. This is interesting too. They don't have ever declared dividends. Look at that. Their dividend yield is 0. That's what that means. Interesting. You don't have to issue a dividend. That's why a company would issue a stock split. They're trading way too high. Okay, so because the textbook is dealing so much with the American way of doing shareholders' equity, I brought in a problem from another textbook, okay, which is more the Canadian way of doing it. So all these transactions and how would we record them in Canada, right? So Eddie Edwards Limited, a public company, was formed on January 2nd, 2008 with the following authorized capital structure. Preferred shares have no par value, very popular in Canada, no par value sign. The next bit of information, they're just telling us the quarterly dividend rate. It's $1. They're callable. That was one of the features I talked about earlier. And so many shares are authorized. Common shares, unlimited number of shares authorized. So you just incorporated the following selected transactions occurred during the first 6 months of operation. They issued some common shares in exchange for land and a building, right? And you can do that. You can issue shares, not necessarily for cash, but for land and building. They issued some preferred shares, declared the quarterly dividend, okay, on the preferred shares, and a stock dividend, and then paid the dividend later on that was declared. Now, because I took this out of another book, it's not survey. It's asking to prepare the journal entries. What we're going to do is analyze the effect of the transaction on the accounts of Eddie Edwards. Okay. So shareholders' equity problem. Meaning, how did it affect the accounting equation and the income statement and cash flow, statement of cash flow, right? So that's how we're going to approach the problem. Okay. So, January the 2nd, they issue 100,000 common shares in exchange for land in a building. Doesn't necessarily have to be for cash. Combined appraised value of $2.2 million. Remember what I said too in the lecture? If we've got the market value of the land in the building, we take that number first before we take the market value of the shares. Okay, and so we're given it. It's $2.2 million. So in this case, for Eddie Edwards, land and building go up, and so does the share capital. Now they've, land and building often sold together. Sell the land and the building separately. So we need to know what percentage then of the $2.2 million is attributable to the building, what percentage for the land, and they've given it to us. Okay, 60% is for the building. So that's $1,320,000. So I guess 40% would be for the land. Okay. Right. January 3rd. Now they're going to issue shares for cash. Oh, and I should probably specify that's common shares. 1.25. So they issued preferred shares for $1,250,000 in cash. So I'm going to use that number there. And because I've got two classes of shares, two broad classes of shares, common and preferred, I should have two separate accounts for that. So preferred share capital. Then, April the 1st, the preferred shareholders get their dividend. Okay, and generally their rate is, the dividend rate is right in the description of the preferred share. On April the 1st, that's when they declare it. They do have to make an entry on their accounts. And we see here that it's $1 per quarter. So, it is the end of the quarter. It's April the 1st. Every shareholder gets $1. Okay. So what do I, dividends payable. So I multiply $1 by what? Is it the 50,000 preferred shares that we've issued January the 3rd? That amount? Or is it the 100,000 shares authorized? How much? The shares that are authorized and shares that are issued. Issued, the ones that are out there. They have 100,000 shares authorized. They've only issued 50,000 shares. There are therefore only 50,000 shares that are eligible here for this dividend. The other shares, the company still hasn't issued. They're tucked away in somebody's cabinet. So dividends payable goes up by 50,000. Retained earnings goes down. So this is plus. April the 10th, declared and distributed a 5% common stock dividend on all outstanding common shares. So here they're telling us to. This is on the outstanding common shares. So I guess what we need to know is how many do we have outstanding? I know we issued common shares at the beginning, eh? 100,000 for the land in the building. And that's it. So now we're going to be issuing 5% more. So that's an additional 5,000 shares with this stock dividend. Okay. And we multiply that by the market price at the time. All right. So how does this affect the accounts and the statements of Eddie Edwards? Well, the assets haven't changed, but certainly common shares distributable. And because it's a dividend, retained earnings is going to go down by 120,000. Any questions so far? Yes. Oh, outstanding. That's just my short form. Outstanding. That's what that means. Should write it out. Then, April 25th, that's the day that we pay the preferred dividend that was declared on April the 1st. Let me just show, this is the previous piece of paper here. This is the preferred dividend that we're keeping here in the dividends payable account from April the 1st, the date of declaration. It's now time to pay it. So we're going to reduce the dividend payable account. So that was 50,000. Cash goes down by 50. Okay. All right. The next section, we haven't really taken a look yet at the shareholders' equity section, so let me just do that. So, financial reporting of liabilities and equity. So, what I'm going to do here is just show you the most previous audited financial statements. This is for Loblaws Company. Loblaw Companies. That's the official name. Everybody calls it Loblaws, right? But their official name is Loblaw Companies. So they've got a consolidated balance sheet. They only call it consolidated because they're taking a number of companies and putting them together. Nothing to worry about in this class. Someday, if you continue on in accounting, you'll have to worry about that. So liabilities, they do have some bank indebtedness. Okay, so we're just looking at how they report liabilities and equity here. And so that would be at the principal amount of any bank loan. They do have some accounts payable and accrued liabilities. We've seen that before, that accrued liabilities. So, if there are things that we know we have to pay, like dividends payable, okay, or wages payable, we generally make an accrual for them, and we've termed them accrued liabilities. Income taxes payable, we certainly looked at that today. Okay, so they've set up an amount there. They took their tax rate multiplied by the net income before taxes. And they've also, this is a classified balance sheet. Remember, current liabilities are those that are due within 1 year. They have some long-term debt where the principal portion is due within the year. Okay, and that's why they've got that there. They do have some long-term debt, and it says, go look at that note. And I think if we look into that note, I don't have it with me, we might see some bonds. Okay, it wouldn't be uncommon for Loblaw companies to have issued bonds. They've got some other liabilities. Future income taxes, I know the book talks about this, but I really don't want to get into the discussion about that here, or minority interest. That's for another class, not this one. Under shareholders' equity, they do have common share capital. Okay, so as they issued common shares, Loblaw companies set up their common share account. This is all in millions, so that's $1,308,000,000. They do have retained earnings. We're all familiar with that. And the accumulated other comprehensive income, I really don't want to get into this class. You'll notice there are some things here that your textbook has that are not recorded here, and that would be additional paid-in capital. Please ignore all of that discussion in your textbook. And I guess that's it. Additional paid-in capital because of that par value. Okay? So that's how that's recorded. There is an additional statement I'd like to show you as well. It's called the Statement of Changes in Shareholders' Equity. Okay, that on this slide we're talking about that. And so what we do in this statement, this is for Loblaws again, is for every one of the shareholders' equity accounts, we show the changes in it. Okay, so common shares. They have a common share capital account. What was the balance at the beginning of the year? How many did they issue? And how many did they purchase for cancellation? Okay, Loblaw Companies is probably registered under the Canada Business Corporations Act. So if they repurchase any shares, they have to be canceled. Okay, so that's what they're showing here, $8 million worth. Okay. And then they also have to show the changes in the retained earnings. Right? So this is like your retained earnings statement that we've seen before. It's often incorporated into this statement. Okay, so beginning balance, and then any changes, the biggest ones being net earnings and dividends that are declared. So 84 cents a share. And then we also see, and we don't need to know this, the changes in other comprehensive income. But that's beyond this class. Okay. So that's how they're reported on the statements. Earnings per share, it's exactly that. How much of the net income can we attribute per share? So we divide it by the number of shares. Yes, and it is followed closely by the financial press. And almost everything here that talks about, this AGF management Q3 profit, it says, oh, the profit for the quarter was $27.8 million or 31 cents a share. Okay. It's almost on everything. Where's my finger? There we go. Okay, compared to $22.8 million last year or 25 cents a share. Because the shareholders always want to know, well, what's my cut of that profit? Okay. If you were to give me all of that profit, how much would I get? And it generally is required disclosure on all the income statements, okay, public income statements. And what should a company do? Issue bonds, issue shares? Well, it depends. You have to take a look at the tax consequence of paying interest. Okay? Interest lowers net income. However, interest expense is tax deductible. How does not dilute the share ownership or control of a company. Shares don't have interest expense. They have dividends, dilutes control of the company. So we see a lot of trade-offs here. And that is the end of Chapter 8. Have a good week.